Welcome to the webinar covering the basics of the Corporate Transparency Act, or referred to as the CTA, and the new beneficial ownership information reporting requirements. Today, we'll be covering the background of the CTA, who needs to report and what exemptions are included, deadlines, definitions of beneficial owners and company applicants, reporting details, updates and corrections, and penalties for non-compliance. A little background here, the CTA was signed into law January 1st, 2021 as part of the National Defense Authorization Act. Its purpose is to fight against financial crime, money laundering, and other illicit financial activities. The main goal of the CTA, in which to enhance corporate transparency, requires certain entities to disclose information about their beneficial owners to the Financial Crimes Enforcement Network, or FinCEN. This information will be granted to authorized users, such as law enforcement agencies and certain financial institutions. And FinCEN actually released the final access rule on December 21st of last year that outlines exactly who's going to be able to see this information. It's not going to be a public database that's accessible to everybody. The final rule sets stringent security protocols for authorized users to get access to this BOI, and they promise to have routine auditing for those who do obtain access. The companies required to report are only those that meet the definition of a reporting company, and they don't qualify for an exemption. So there's going to be a few types of entities that aren't going to be required to report. But the two categories of reporting companies are domestic and foreign. Domestic reporting companies are those that were formed under U.S. state laws or tribal law or similar bodies. That includes LLCs, corporations, limited partnerships, certain trusts, and other legal entities. Foreign reporting companies are those that were originally formed in a foreign country, but registered to do business in the US by filing with the state or a similar office. To determine if an entity is a reporting company, the key is to look at how it was formed. Not just any filing with the state will make it a reporting company, but a filing that results in the official formation of the company. Take a trust, for example. If it was formed by filing documents with the Secretary of State, it is going to be required to report. On the other hand, if the trust's existence was established solely through the execution of a trust agreement without state involvement, it's not going to be considered a reporting company. For example, statutory trusts and business trusts can be created by filing formation documents. Some states require it for formation and others don't. Now, as I mentioned, there are some exemptions. There are 23 types of entities that are not required to report. These entities typically have some other reporting mechanism similar to this one already in place, or they're not structured in a way that illicit activities are likely to occur. It's important for practitioners and business owners to understand that 88.9% of all existing entities in 2024 are not exempt and are going to need to report. Of those 23 types, I'm not going to list them all, but I'm just going to talk about a couple. The first one is large operating companies. To qualify as one of these, the entity must have more than 20 employees in the US, have a physical operating presence in the US, and its gross receipts reported in the prior year tax return is more than $5 million. And this is going to be net of returns and allowances, and this threshold has to be met excluding international receipts. On the previous slide, I mentioned that about 89% of companies will have to file. So of the 11% that are going to be exempt, only 4% of the exemptions are large operating companies. So just because an entity is big, you shouldn't automatically think that it's going to be exempt. The second exemption I want to cover is inactive entities. There are 6 criteria that must be met. The first is that the entity has existed on or before January 1st, 2020. It can't be engaged in active business. It's not owned by a foreign person. There's no change of ownership in the last 12 months. The entity has no assets or ownership interests, which includes the ownership of other entities. And it hasn't sent or received more than $1,000 in the preceding 12 months. It may be necessary to continuously check this exemption status to make sure that a company continually qualifies for an exemption. If a large operating company goes from 20 employees to 19 employees, they're no longer going to fall under the exemption, and they're going to need a report. If a reporting company files a BOIR, and then becomes exempt, they will need to file a newly exempt entity report, which is one of the reports, one of the types of BOI reports that I'll cover later. But this is to inform FinCEN that the entity is no longer subject to update requirements. As for deadlines, they are based on the formation date of the entities. So for those that were created before 2024, they have 1 year to report their information with a due date of December 31st, 2024. Entities created during 2024 will have 90 days from formation to file. Entities created during 2025 and after will only have 30 days to report their information from receiving confirmation that they were formed. So the 30 days was the original deadline, even for 2024 entities, but FinCEN extended that deadline to 90 days so that entities could adjust to this new requirement. So beneficial owners are going to have to be reported on these reports. So there are two ways to satisfy this: through ownership interest and through substantial control. Those with ownership interest are individuals who directly or indirectly control 25% or more of an entity's ownership interests. Ownership interest includes equity, stock, voting rights, capital or profit interest, convertible instruments, options, and anything else that represents ownership interest. In tiered entity structures, you might need to calculate the percentage of ownership interests held indirectly for certain client investments. So taking the diagram on the slide as an example, you would need to calculate if the owners of entity A will also be the beneficial owners of entity E. Something to remember about beneficial owners is that they're always individuals. So if an entity owns another entity, you have to look through to locate the individuals. The second definition of a beneficial owner is a person who has substantial control. A person meets the definition of substantial control if they meet any of the 4 categories outlined in the final regulations. First, they are a senior officer. So think about your C-suites: president, CFO, CEO, COO, or any other person that performs these duties. So they may not have these types of titles, but they do duties similar to senior officers. Second is that they have the appointment or removal power of they can remove any senior officers or a majority of the board of directors. The third is those that make certain important decisions about the business, its finances, and structure. For example, those with the authority to sign or influence the entry or exit of certain significant contracts, sales, leases, mortgages, transferring major assets. They can make calls on reorganization, dissolution, or mergers. Those are the types of people that are going to be beneficial owners by way of substantial control. There is kind of also, so the fourth category is a catch-all, and that's at the end of the definition. The 3 that I named before are a little bit more definitive, but the fourth one is any other form that indicates substantial control. It kind of leaves a little bit more room for interpretation. So owners and professionals may want to consider erring on the side of caution. If there's someone on the fence that may be but may not be a beneficial owner, it may be worth reporting them to be safe. Now, there are a few exceptions to beneficial owners. These cannot be minor children. The parent or guardian would be reported in place of them. Individuals acting as a nominee, intermediary, custodian, or agent, so a tax professional, for example. Employees of a reporting company, and those are people who have substantial control over an entity solely from employment status, and they're not a senior officer. Individuals whose only interest in the company is a future interest through a right of inheritance. And then also creditors. Company applicants need to be reported by any newly formed entities. So those formed before 2024 will not need to report company applicants. These are individuals who directly submitted the documents responsible for establishing or initially registering the reporting company, and those who were responsible for guiding or managing the submission of that document. Company applicants must be individuals. They cannot be companies or legal entities. For example, if a lawyer draws up the documents for creation and then sends you to file online through a service, then the lawyer and you are both company applicants because you directly filed the documents of formation and your lawyer directed you where to file. If the lawyer completed the whole process for you, then the lawyer would be the only company applicant. If you use online incorporation services like LegalZoom or Rocket Lawyer to form an entity, then the company applicant is the one using the online service. So in some cases, a company applicant may also be a beneficial owner of the entity. So the information that's going to be reported on these reports about these entities and beneficial owners are, so for reporting companies, it's the legal name, any trade names, a US address. It has to be a US address. It can't be a foreign address, and it cannot be a PO box either. The jurisdiction of formation, the original jurisdiction of formation, and then the EIN, or in some cases, a social security number for example, single member LLCs. If you have an EIN, then that's what you're going to use. For beneficial owners and company applicants, they're going to provide their legal name, their date of birth, their residential address, an identifying document number from a driver's license or a state issued ID, a passport, or if all else fails, a foreign passport, and then also an image of that document. For company applicants, for their address, they have the ability to report their business address instead of a residential address, but owners have to report residential address. A FinCEN identifier, or a FinCEN ID, is a unique identifying number that FinCEN will issue to an individual or reporting company upon request after the individual or the company provides the required pieces of filing information that I mentioned on the slide before. So this number isn't required at all. You don't have to get a FinCEN ID, entities or individuals. Entities can include an individual's FinCEN identifier. It's a 12-digit number instead of their 5 required pieces of information about the beneficial owners or the company applicants. So this is a great tool for individuals for enhancing security and relieving administrative burden when information changes and an individual is going to be on multiple reports. Those who get FinCEN IDs will keep their information up to date with FinCEN via their login.gov account, which is where they will apply for one to begin with. Companies may request a FinCEN identifier when it submits an initial BOI report. There's a box on the form that they can check for that. Under certain unique circumstances, entities can report other entities, FinCEN IDs, in place of beneficial owners if the owners are the same across the entities. However, a thorough analysis should be conducted before doing this. So currently there are 4 types of BOI reports. An initial report is the first report that each entity will file by their due date, by their deadline that I mentioned earlier. An updater report is filed when information that is previously filed is no longer up to date, it's changed. A corrected report is filed when information previously filed was wrong and you need to submit the correct information. A newly exempt entity report is for those that have filed a BOIR and then they fall under one of the 23 types of exemptions from reporting altogether. So the BOI report, it's not an annual requirement or anything like that. However, it doesn't stop with the initial report. If there's any changes, then it needs to be reported. And this has to be done within 30 days of the change, or if it's a correction, it needs to be done within 30 days of realizing that the information was filed incorrectly. Some common triggers that require filing are a change in residential address, and an owner can update their addresses in their FinCEN ID application rather than the entity needing to file a report. But if an individual doesn't get a FinCEN ID, then an updated report will have to be filed at the entity level, reporting any new or changes of address. Death of a beneficial owner. An updated report would need to be filed to remove this late owner's information and then add any person that inherits the interest. And then any change in beneficial ownership due to management decisions. This could be hiring a new CEO, creation of a new officer position, someone sells their ownership interests. These are all need to be reported with the new current individuals. Also, having to do with beneficial owners is their changes in name or identifying document number. So this could be when someone moves to a new state and they get a new state issued ID, which would require the update to an address, the ID number, and an image of the ID. Another common trigger here would be a change in legal name, perhaps due to a marriage. And these are also able to be eliminated on the entity level if the owners get a FinCEN ID. Lastly, would be any changes in reporting company information. So if the company moves to a new principal business address or gets a new DBA or trade name. I want to point out something very important here, though. Changes in company applicant information do not require the need for an update. This only the update requirements only apply to beneficial owners. However, FinCEN asks that company applicants who get FinCEN IDs keep their information up to date in their login.gov account as they're helping form entities as time goes on for their information to be up to date. So changes in the changes in their information will never trigger the need for an entity to file an updated report. Finally, there are some penalties for failing to submit a report. They can be hefty, but entities could incur daily fines of up to $591 for each day the report remains unfiled. Criminal penalties may include fines of up to $10,000 and imprisonment for up to 2 years. And so these penalties are for non-compliance. So in the sense that if companies don't report or they do so inaccurately on purpose and knowingly, this is what they're going to face. There are also penalties tied to unauthorized disclosure of BOI, meaning those authorized users that I mentioned earlier that are able to use this database of information face even heftier fines for sharing BOI without authorization. If they do so, they face penalties of up to $250,000 and 5 years in prison. So now I'm going to answer a few questions. So will individuals who will be a beneficial owner and a company applicant need to get 2 FinCEN IDs? So all individuals have 1 FinCEN ID if they choose to apply. Those who may be both a beneficial owner and a company applicant will have the option to enter both their residential address and their business address when they apply for that ID, because that's like the one piece that's a little bit different between the two. Does my entity need to file a report if it dissolved during 2024? So the short answer is yes. It may come as a surprise, but if at any time on or after January 1st, 2024, the entity is a legal entity that meets the definition of a reporting company, then they're going to be subject to the reporting requirements, even if they completely and irrevocably dissolve before the due date. For many, this is December 31st, 2024. So if an entity dissolves today, it's before their due date of December 31st, but they're still going to need to file a report by the end of the year. If an entity was permanently dissolved before January 1st, 2024, then it wouldn't be subject to reporting requirements. So take note here that this does not include administratively dissolved entities. Usually these types of entities are not irrevocably terminated, which means that it may still be subject to reporting requirements. Who are the beneficial owners of an entity that is owned by a trust? You must identify those with ownership interest or control over the trust's ownership interests. So you'll need to kind of as well look through the trust to find those with control over it. Depending on the trust mechanics, this could include the trustee, investment advisor, trust protector, or a beneficiary. Situations may vary here, and it's important to consult with an expert on who would need to be reported in these scenarios. I appreciate you taking the time to listen in on this webinar today on the Corporate Transparency Act basics. Please feel free to reach out to us at info@securecompliance.us if you have any questions or if you're interested in learning about how our software helps you be CTA compliant. Whether you're a business owner or a professional looking to offer services to your clients, we have a software that keeps you in the driver's seat. Thanks.